Hi there, it's Terry Bell here at Bell & Company with the Debt Strategists, and we're finishing off this small series of webinars that we've undertaken in respect of the very serious subject of bankruptcy. I always say it's not the sexiest subject, but it's very important and vital that people understand the ramifications of bankruptcy. And unfortunately, in this field, we're going to get busier and busier. And what we're trying to do in this series here is share our experiences, our knowledge, our intellectual property to a fair degree. Before we get going here we are on Friday already, jeepers, the end of the month, but we're just waiting for a couple of other people to join us and then we'll kick off in earnest. So as I say, it's been a very busy month for us as things start to open up and people start to see the consequences of what's happening here. And I would say this anyway, but it's so vital that, and I'm going to labour it slightly in this webinar, that people get the right advice. Whether they choose to act on it is another thing, but right advice just cuts out a lot of the BS that's out there. Right, so we'll get going here. Welcome everybody. As the final part of our series of Introduction to Bankruptcy, we're looking at assets at risk. What we're doing, as is with most of these webinars, we can only really talk around it because you get every case is different, everybody's needs are different, their asset profile, their credit profile, etc., etc. The trustee of a lot of moving parts, but we're giving you the bare bones so that you can take the right decision, as it were, for you, which is vitally important. So we'll get going, particularly talking about assets at risk, which is basically what everybody's concerned about. Should they worry about bankruptcy, be under the threat of bankruptcy, be subject to bankruptcy proceedings and or bankrupt at the end. So again, we've tried to give you the context and we're going to continue that theme. As ever, if you've got specific queries from this webinar, just give us a shout and we'll answer those on a one-to-one basis. There's an email address at the end. And then if you want us to act for you, then that's a slightly different ballgame. But anything from this, specifically from this webinar and others, you're very welcome to contact me and we'll see what we can do and help you with your specific need at that point. So what I've got, as ever, I've got my trustee PowerPoint, which I need as my base script, but also I think it gets, what we're trying to do with this as well, present it in a way where things hang together. In the first part, we're going to be going over a couple of bits on the last two webinars so that we can get this joining up as to where we're going to, the key point, as we said, usually is people concerned about their assets at risk. We're looking briefly at debtors and creditors petitions, a slight nuance there in terms of assets and how they're treated. And we revisit our friends, the trustee. We have a quick case study there. One of my colleagues, Rory's going to jump in with a pre-recorded video in terms of a success we recently achieved for somebody who was bankrupt in discussion with a trustee. Then we go on to the matter in hand. And the primary asset always is the home. And again, get the right advice. I'm going to give you an example. There was an absolutely horrendous piece of advice that did some people some damage. And we're going to have a quick whistle stop through other assets. And again, depending on everybody's case, it's how vital they are or otherwise. If you have a number of assets in there, sometimes it's a case of coming up with a wish list of what you want to keep. And then finally, I'm going to reinforce something right the way through. Bankruptcy is about commerciality. If you have to fall on your sword and go bankrupt, you have the opportunity to eradicate large amounts of debt, unsustainable debt, and at the end of the day you're trying to strike a deal or lose your assets. We go back to your new best friend, is what I call a trustee, and I'm going to go on about the Perjury Act because it's so important that you adhere to the laws here. And finally, a little bit of mindset stuff, be realistic about it because it's everybody involved, especially if you've got your family. So parts 1, 2 and 3. So we'll kick off with part 1 here. We're looking at our previous couple of webinars that we've done on this. So we looked at the first one and it wasn't patronising in any way, but what we said is eradicate the fear of bankruptcy. As I said, there's lots of misinformation out there. I think the very last point I'm making today's webinar is don't Google things that are, so you can contact any disease on Google if you're that mindset. And it won't be relevant necessarily to your specific case. And some people rely on Google to support their argument, and their argument may have been wrong to start with. So we referred to it as a commercial opportunity, and we gave an example of the builder guy who took out 6 peer-to-peer loans with about 75 grand of equity, making it a lot easier for him to solve the situation with the trustee and get his interest in the house purchased and retain the family home. Then we talked about debtors and creditor petitions, the two styles of those. Debtors petitions, you choose to control your destiny. Creditors petition, somebody's after you, they get you, they bankrupt you, and your financials all go under the control of the official receiver and or a trustee. Then we went through the process, and the reason we went through the process in a little bit of detail was there are opportunities along the path to deal with this if you can. Again, that's subject to a number of things, including the person or company that's trying to bankrupt you and their attitude. We discussed the fact that some companies just bankrupt people unless they pay in full. Particularly prevalent in that field are builders, merchants, to name just one industry. Dates are absolutely key. Don't miss your dates and your timelines and everything else. Meet all deadlines. Even with the backdrop of trying to say defend yourself or get out of avoid bankruptcy, make sure you know the backdrop and the consequences if you are bankrupted. That's very, very, very important, because you need to have an idea. Otherwise, you've got that continual fear, the continual unknown, which isn't good and which definitely isn't healthy. And then we went through a bit of work on the official receiver, and or if he passes the case on to a trustee. So just a little bit of recap there, what we did in those two webinars, which then sets us up to revisit, sorry, that's the wrong slide, to revisit the next point we're going to go through. Today, we're talking about assets and risks. Bankruptcy, to state the obvious, is there to get a return for the creditors. Within that generalised statement, there are a lot of moving parts. There are assets that can be easily realised, assets that can't be realised, other people's interests, the trustee's cost of realisation, something we'll go on a little bit later, but there's lots of moving parts. But at the end of the day, it's to get a return for the creditors from the entirety of somebody's debts. It includes all your worldwide assets, and a couple of things we're going to go through here that it covers everything. If you've got a holiday home, if you've got a boat abroad, if you've got whatever abroad, or whatever it is, it's your worldwide assets. They're essentially up for grabs. Now, some people are take an approach where they think if it's not in the UK, then don't worry about it, it'll be safe. Someone told me it was safe on Google. That's not, and worst of all, you'll purge yourself, okay? And the Perjury Act is pointed out to everybody that goes into bankruptcy. The official receiver is quite vociferous usually in the delivery and explanation of the Perjury Act, making sure you understand it. If you tell a lie, you can be hauled into court and ultimately you can be imprisoned, as it's a criminal offence. If you try to hide assets, invariably, there should be a word, they will be found, especially if the trustee is in a position to quickly realise funds to allow him to extend his investigations. This has then taken a turn very recently, where now we're finding there's litigation funding out there, and that is almost like fueling trustees to go and do that work straight away. And it's used sometimes in a very draconian way. Sometimes there's freezing orders, there'll be charges thrown on everything else, and once they get their claws in, and if they don't believe you, something we're going to go on a bit later on, if you let yourself down and lie in this process, you lose all credibility on anything you're trying to say, because you're just simply not believed. They won't believe you anyway, but if you let yourself down in that sense, that completely reinforces their opinion of you, and thus they're going to go for you even harder. So be aware of that. Going back to the commercial word, you need to understand the risks. If you've got £100,000 of equity in your home and you think you're going to just have to pay $10,000 for that, you're taking a very risky policy. It's your home at the end of the day. And you need to know then if you're going to stick, if that is all you have got, all you can get, whatever the situation is, then you need to understand your exposure in that. Ultimately, if the trustee sees that he could get more commercially by securing the property, repossessing it if you like, and putting it for sale, then they will take that stance, because they have to be commercial. And going back to the first point, they're looking to maximise the return for the creditors. So the typical assets we see in most instances are the home, businesses. We're going to go through a little bit of detail on that. Obviously investments, but different types of investments, and a few others, such as cars. That's always quite a bugbear usually. And there is a provision for a car, but it's a very low value. So if you've got the Range Rover on the drive and it's got no HP on it, that's going. But you can go and grab yourself a wee Fiesta for a couple of grand, something like that. I'm not going to go into the minutiae of all these, but we're just giving you the overall perspective. And the other thing we've got to look at is if you're going to make a commercial offer here, you've got to make it feasible. It's got to be fully explained, validated with valuations, with mortgage offers and everything else if you're trying to, say you're trying to look after the family home. And you need to understand what the trustee is trying to do as well. He will work with you. You have to be very careful. To my mind, and I apologise if I offend any insolvency practitioners, but they wear two hats here, and conflicts do exist. But they have a job to do, and in the main they do it very well, and you just need to keep them, and I'll use the phrase a few times here, as your new MBF, your new best friend. So I want to go back a little bit more into the debtor's petition versus a creditor's petition and explain what we're trying to say here. If you are going to apply for your own bankruptcy through the court process, then you must have one of two positions. You must either have no discernible assets that are at risk, you rent a home, you have a small car or a company car, you own very little around you, then that's one issue. Then you can say, right, I've got 50,000 credit cards and a 25,000 guarantee and a 10 grand tax bill. Cool. You may take that view. I'm not going to clear that sort of £85,000 of debt, so therefore I can take the commercial decision to avail of the law and petition for my bankruptcy. Or you have a controlled asset position to negotiate out of. What I mean by that is you say, right, I've got some debts, they're sat on one side, and say I've got two assets. I don't own the car, but I have equity in my house, and if the equity is say 50,000 and the parents or parents-in-law are going to assist with paying for your equity in your property, then that's what we call a controlled asset position. You know what you're in for. You're going bankrupt with a view to eradicating a huge amount of debt or any amount of debt, but you know how you can do it, and you can see that through to the extent you've got somebody at the end who will ultimately buy your interest in the property. We also mentioned before, and it's important to reinforce, the attitude of the official receiver and or the trustee if you petition for your own bankruptcy. You're nearly seen as responsible, taking control of your affairs, and you're looked at in a different light completely. Straight away we go into creditor's petition, and then I can give you the flip side. They will never say this or never write this, but if you're bankrupted, i.e. there's a creditor's petition against you, they will take a different view. It's nearly a case, like I said before, come here, what have you been up to? It's that sort of scenario. So you're a bad one, essentially. You're not, but they have to start from somewhere that you must have done something wrong, and we assume something else is going on here. And in that instance of a creditor's petition, assets obviously become at risk because you haven't been able to meet the debts, especially the creditor that petitioned for your bankruptcy, and it's trying to wrest back that control so that it's not if you're going to lose your house, it's how you still control that even. But it's trying to keep things that are near and dear to you as close as you can, so you have that ability to try and get out of where you are. And as I say that, I'm labouring with delivering it, it is sometimes difficult. You've got to be ready to negotiate commercially, and most importantly, to perform and settle whatever debts or whatever the trustee in bankruptcy is after. So you've got to be in that position. And again, the trustee is coming from a position, well, you were bankrupted, I'm going to check everything about you, I'm going to know your star sign, your inside leg measurement, and they're looking at you as though you're guilty. They don't know what of, but you're guilty. And so it's that sort of attitude. It's just important to get that right again. Debtor's petition, you're controlled, you know what you're going, you're taking the right advice. The creditor's petition, you've been whacked and you're bankrupt, everything's into play. The trustee is having a good look round, and he has, to a degree, his own agenda as well in terms of what he's doing. He's got to do the best for the creditors, but he's also got to earn a living, and it's where they go with that. And sometimes, there's a point a little bit late here, sometimes that needs controlling as well, and it's a different scenario. Creditor's petition is a completely different scenario. Just going to finish in this first section about the trustee appointment and their roles and powers. Okay, it's repetition is vital, right? But in terms of your new best friend, they can be the most obstinate, excuse my French, bastard, right, going. You still need to try and get on with them. Then some of them try and clash with you. It's all part of a policy to poke you and find out what you're about, where your weaknesses are in all this emotionally. If you turn up at a meeting with your trustee and break down about the house, they'll, that's the weak point. So you've got to keep the right side of them. Try not to get into personals with them, because that makes it a lot harder. And keep going on about it, MBF. Typically, if a case involves more than £15,000 worth of assets, the official receiver will transfer that to an insolvency practitioner, who will then in turn be your trustee in bankruptcy. And again, it's every part of the relationship is very important with your trustee. Initial approaches vary considerably. Some come down like a ton of brick and start freezing assets, closing businesses, lifting the car, putting charges everywhere. Others take a slightly more measured view and look to make sure they get your full engagement to make their case go through. If they have information, though, that thinks you may be putting assets offside, or they think you've recently transferred something, they will act very quickly. And you've got to work on the basis that if bad news comes and you get a bankruptcy, there's a good chance, and I'll mention a case a little bit later just in passing, other people will ring up the official receiver and trustee and say, did you know that this man or woman owns that? They could be talking garbage, but they go to a caravan every week down at the beach, and so they must have a caravan. People are quite malicious, so you just need to be ready, always on the basis you're trying to be as open, as transparent as possible, show no emotion, get on with the trustee and drive to it. As I mentioned earlier about, yes, they're human beings, trustees, and you've got to work with them. They're there to earn fees at the end of the day. They have to be careful and conduct themselves properly, not to take the mickey. Although there's many cases where we see what we politely call unjustified fees, and we have to look at that and see what's going on. So they're after their fees, plus then the creditors. So if they run up a bill of 20,000 and the bankruptcy estate only realises 20,000, strange enough, there's nothing going back out the door to the creditors. And it's again a thin line between calling them out if you think you're taking a mickey and or getting on with them. So it's a tricky place, tricky game to play. So, but be aware of it, just so we know it. All these moving parts we need to be aware of. Okay, don't try to hide assets. Don't lie. I've mentioned it before. It will completely undermine anything you try and later do. If they catch you out on one thing, they're looking for everything else. If you say, I can get 100,000 for that, they're going to be going through it. They're going to go through anti-money laundering, but they're looking at it as though you must have that 100,000. So you've got to be very careful. We have instances where clients come to us, tell us a scenario. That's it. So you didn't say this and you didn't say that. And then you go to the trustee, they told us this, they told us that, they told us everything. And then sometimes our clients decided to omit something with a trustee, but tell us. We will never, ever be compromised. And we have to find out how we introduce that assets. If our client says don't do that, we're not acting, end of. You've got to be so transparent. You've got to be commercial, but very transparent. And you start hiding things, everything else, it's going to be crazy case for you. Their powers are immense, and now they're fueled with the litigation funding. It's going to be sort of a heady few years here after the COVID and after whatever form the recession takes, because a lot of businesses are going to suffer here. And there's been a lot of increased value in assets over, say, the last 12 years. And a trustee, to all intents and purposes, runs your financial life. If you earn more than you need, you've got to make a contribution to the bankruptcy estate. If you're going to realise, they can realise all your worldwide assets up to the point where it equals the debts plus their fees. And again, that's where the fees becomes important. So they can do anything. They can make applications to court if they're ignored. There's various powers, and the insolvency law is relatively complex, but it's very well interlinked in case things don't happen or you don't perform as a bankrupt. So just understand that fully. Show no emotion. Okay, you may Nobody wants to lose their home. Nobody wants to go bankrupt. Nobody wants to suffer. If you show emotion, I'm going to give a very brief example in a minute how we turned one round on trustees because they were torturing a client of ours in a good way, not a malicious way, but in terms of mentally sort of thing, because they were playing the game and negotiating the situation out. We turned it round after a client literally broke down about losing his home. These emotional weaknesses, as I'm saying, outbursts, show incredible weakness, not as a human being in terms of commerciality. You show your hand. It's a bit like playing poker and you get a hand, you go, oh, that's a good hand. Or, it's a yep, cool. If you think of a home, and we'll use the line in a minute, it's four walls and a roof, okay, and you can rent anywhere. So a little bit reinforcement as we go towards the assets, because that's going to help set up more and more the commerciality of bankruptcy and also the levers, both sides that come into play. I'm going to take a little break here and get a glass of water, and what I've got here is a little video from a colleague of mine, Rory McGimpsey, who's one of our senior guys who does a lot of negotiation in trustees, does across the board, but he's going to give you a quick case study here so that you can see sort of an example of a result we've managed to achieve in conjunction with a client. So play it away, guys.
Hi, I just wanted to share another example of a great success that we've had. We recently helped a client who was made bankrupt and had 4 properties with the trustee in bankruptcy. The properties were transferred to his son less than 5 years ago, and this was overturned in the bankruptcy due obviously to the 5-year rule. He wanted us to assist with purchasing the home and also then a secondary property, and agreed to let go of the other 2 properties as he was unable to raise the necessary funds. Due to our tough negotiating and continuous engagement with the trustee in bankruptcy, we managed to get an acceptance of £108,000 for £174,000, a write-off of a whopping £66,000. Furthermore, on the secondary property, we managed to achieve a settlement of £12,000 on a trustee interest of £34,000, a further write-off of £22,000. In total then, we saved the client just under £87,000 across the 2 properties. Absolutely fantastic result, as I'm sure you'll agree. Just an example of some of the great work we've been doing recently.
Hi there. So we're looking at matters on assets at risk. That's a mouthful, but we're looking at assets that come into play in terms of a bankruptcy estate, and these can include all your worldwide assets. So it's all available assets, be they hard-standing, freestanding assets, including equity in various things. That equity could be typically in your property, but also, for instance, could be in a car. So if a car is worth 50,000 and you've got 15,000 of HP against it, there's 35,000 pounds of equity. It'll include your home, any buy-to-lets, and along those lines, and business assets, which we'll look at in the next section there. I've been talking a lot recently about the controlling the commerciality of a situation. And what you're trying to do there is going back to that thing of making sure you conduct yourself properly in bankruptcy and keeping the control of the commerciality of the whole deal. There are costs. Do not act in such a way as to increase those costs or give cause for those costs to rise. That way you can help minimize costs by transparently attacking the problem and coming up with a solution, and also if you've got to buy equity back, making sure you can perform and settle the deal there. Inaction, we just had a client there, he keeps going cold on us. We're saying, right, don't think the trustee, because you're doing nothing and ignoring us, ignoring them, that the costs aren't going like that. The man has an immense amount of equity in his house, and it's nearly like a pile of cash for the trustee. He doesn't perform, react, do as he's told, complies. Trustee costs are just on the rise, so we're just having to explain that to him. And if you're difficult, costs will increase. If you tell the trustee to off and stuff like that, they're going to dig their heels in. They're going to make more inquiries. They're going to get other advisors. They're going to do more searches, all of which increases the cost. So it's keeping a control of that cost base. Now, we've talked before about the powers that a trustee has. And in terms of a bankruptcy, on the proviso you conduct yourself properly from in your bankruptcy, i.e. for that year, from the date you're bankrupted to day 366, then you are discharged. But the trustee has 3 years to deal with the assets. and that can be extended if there are difficult cases, if it's a difficult asset to realise and things like that, then that can be extended. But they 3 years to sort this out, because obviously trying to sell a property in a year that requires or has an issue or whatever, and that could be the family home as well, they need more than a year to make sure they can maximise the return for the creditors here. Now, if somebody has a number of assets, say they've got home, a buy-to-let, a place in Spain, a car, a boat, whatever, and a list of assets there, something's got to give. So the trustee is looking to realise all of them up to the point of the level of the debt and or his costs. But it's very important psychologically and in your planning and the commerciality, which I keep going on about, to make sure that you've got a wish list. Home obviously nearly always comes first. Business may be next. The house, the buy-to-let your mum lives in, your mother-in-law lives in, and things like that. And go as you go down, so that the boat you've got may be last. Your Range Rover may be going. Your if there's cash and investments, they get cash. They get cashed everywhere. Anyway, sorry. So, but you need to grab yourself a wish list on what you're trying to work to retain. Home is usually sacrosanct, and we've got to fight as hard as we can, with the help of others, to make sure we keep our home in bankruptcy, the family home, usually in bankruptcy. So to do that, you've got your wish list, then you must be able to perform, and you must be able to access funds to buy the trustee's interest. It's your interest in the home. He now controls it. He will turn to your co-owner of the property, something we'll come back to in a minute, and say, do you want to buy the share, or shall we sell the property? You get your bit, I get my bit for the bankruptcy. You need to be if you're going to try and keep it, you've got to pay your way here, and you've got to have that ability to access funds from friends, family, your loved ones, whoever they are. Family should be your loved ones, but the immediate, so your good lady wife, husband, your son, daughter, whatever it is, but you focus obviously on the important assets. You also have to keep an eye on the insolvency practitioner's costs and the costs of realisation, because they can get a little bit out of hand here. As a bankrupt, you're nearly third party removed from, say, from a transaction. The trustee is appointing people, he wants to act, and all those costs come back in against the bankruptcy estate. So again, keep it simple, be swift, be precise, and be transparent in terms of what you do. Should make all of it ensure, as I say there, repeating myself, but commerciality is all. All these little bits just add up as time goes on. And you need to understand the trustee. You need to understand their role and not pay lip service. Yeah, you just got to get some money in. Absolutely they have. But all the parts of what goes on. And then if you do that and you ask the right questions, you can hold them to account to a fair degree as well, which is pretty important to my mind. It's not doffing the cap and do whatever you say, so yeah, top slate off the roof, etc. It's important that you understand their role and also their responsibilities, not necessarily too much to you, but to everybody involved in the bankruptcy. For instance, co-owners in the house and stuff like that, it's just, they've still got to conduct themselves, in the best interest of everybody involved. Now, invariably, we get a number of inquiries, people saying, right, I'm going bankrupt, I'm going to lose my house, okay? And your basis is, and by the time sometimes people get to the end of it, it's not as bad as they thought, but they've Googled it or got the wrong advice. And you may lose your house, unfortunately, in this, but it's not automatic. And there are things you can do, there are things you definitely shouldn't do, but advice is all in everything here. We had an instance where a lady came to us and she was literally tortured. She said she hadn't slept for 18 months. Her husband had got herself into a bit of trouble with the tax man. He was coming down the track to bankrupt him, and she took advice from a solicitor. I use the word solicitor, in that he wasn't versed in insolvency at all. He was a conveyancing solicitor, and he just came out the line, if he goes bankrupt, you lose your house. Okay, so this woman took this on, solicitor spoke, and therefore it is. So she took the advice and literally cried herself to sleep, and then didn't sleep for months and months. And then a friend of hers, asked me to speak to this lady, and the situation was this. She had a house, I'll give you a rough figure, she had a house worth about 150, they had a mortgage of 120 on it, and they had a second charge on the property of about 60,000, if that's correct, I think it is. So essentially, it was in negative equity. The payments were going to be maintained on the mortgage and or the second charge, so there was no equity to realise. The trustee, it didn't even get to a trustee, it stayed with the official receiver. So we explained it to this poor lady and her husband, and they still didn't believe it because a solicitor had told them, this is what's going to happen, you're going to lose your house. Wrong, 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 wrong. Generic advice without knowing all the facts, commerciality, is no use at all. It's a bit like me saying, yeah, I think you've got a heart condition when I just don't know anything about healthcare. But very invariably, if people are asked about something, they try and proffer their advice, but totally unfounded. The solicitor didn't even ask the figures. But she just had that very painful period. And what is very important, you get the right advice and you understand the advice, which sounds pretty patronising, but it's to make sure you do fully understand it, the ramifications of what's going on here. And it's particularly when it comes to home, obviously, which is essentially the principal asset involved in bankruptcy. It's usually the I'd say in about 80% of the cases we deal with, it's all about the home. And insolvency practitioners know this. They see it as something they can go and get and or realise money from it, and they can crank up the pressure on it because they know it's the family home and all the ramifications of that. And I mentioned the ramifications, and that's very important because there's obviously the financial side of things, but the pressure within a family bubble, if you like, if you're walking around and thinking, this is going to go one day, is not great for the family life, matrimonial life, your life, everything else. So make sure you get that full picture. Make sure you know the consequences if it goes wrong. What are your options? I'd suggest that if you're going to lose it, you're going to be renting a house in the immediate term or whatever, but think it through. It's not great, but at least you've done the exercise rather than leave it at the behest of others and get snippets of information. Take it on, understand what could happen. We often say, know the worst, achieve the best. So if you know the very worst that could happen, let's achieve better than that. And then it's a lot easier to deal with. And a lot of people spend their lives quite rightly working as hard as they do to pay off the mortgage, get everything there. There's nothing worse in terms of bankruptcy estate if you've got a totally unencumbered property with no mortgage on there, because essentially to an insolvency practitioner, there's a pile of cash. And it's within reason the value is going to be the value. You don't have to argue too much. A value becomes important when you're trying to close equity if you've got a mortgage on it. But if you've got an unencumbered property, it's a pile of cash. And the way of the world, or the way in Western Europe, if you like, is you buy your home and you pay it off. And it's a soft target if it's there. And home is very important. There are some measures to protect you to a fair degree. So a trustee in bankruptcy can't look to move on your home in the first year of the bankruptcy. And don't forget, they've got 3 years to work out what's going on and start realising all the assets, and if they need to extend it, they will. But in terms of home, they leave you put. They start discussing with you, what are you going to do about this? They get their valuations, they get confirmation of their mortgage balance and everything else, and they put a charge on the property. There'll be a bankruptcy restriction at Land Registry, so obviously it can't be disposed of, and that's public knowledge. So you've got a year to sort yourself out, but what people do and really shouldn't do is go, right, no problem, cool, chill out, got a year to sort this out. Get on with it, because otherwise that year's going to come around very quickly. Here we are today on the 30th of July already, 7 months into the year. Time flies by, seriously goes by quickly. So you've got the family home, and then the ownership is very important. If it's in the sole bankrupt's name and he has no other dependents, no family or whatever who could be in any way related to or reside with him, then obviously that's his property. Then you get the situation what I've called joint ownership, okay? And from our angle, there are two sides to this. There's one where it's definitive, it's Mr. and Mrs. on the mortgage, on the deeds, everything's definitive. So bang, down the middle, 50-50. Then you get instances where, for whatever reason, we had a case the other day where a lady wasn't on the mortgage because at the time of the application there was a threat of redundancy and that would have affected their application. So the house was purchased in the husband's name solely and his mortgage. Now, our angle, a trustee's angle is, well, that's his then. Our angle is there's some implied ownership. If the husband, the wife, the other partner here, not the bankrupt, if they've contributed, not in any form, but materially to what the upkeep of that house, to family life, paid the bills, etc., we have to argue that back, and that's a tough gig, and I've called that a grey area at best. We fight hard for it. We take legal advice and we bring any number of applications of law that we can, but it's not easy, it's not a gimme. So it has to be worked very hard. Definitive, cool, down the middle, no arguments, land registry, etc. In one party's name, the bankrupt's name, but not the other, then it gets a bit trickier. Ultimately, no matter what route you're going down, be it definitive or implied, depends how strong our argument is in the implied, as to how close we can get to that 50% level of ownership. The interest owned by the bankrupt and now consequently controlled by the trustee has to be purchased if you want to retain the home. And that has to be basically the equity split down the middle. If it's 100 grand, do you have 50,000 to buy your bankrupt husband's interest in your property? Yes or no? So that's where it comes into play. That's where we get involved. We do negotiations on those figures and make sure we control it, the costs, etc. And it's a tricky enough area, but it's a lot harder if emotions come into play because it's the home. And we have to then manage the trustee, because if the non-bankrupt, if you like, can't perform and pay for the bankrupt share, their interest, then the trustee can start action to realise the property, basically put it on the market, and then that causes any amount of trouble. Now, if the non-bankrupt doesn't join in the conversation, doesn't perform, is obstructive, is a pain in the backside, whatever you want to do, and basically stops the trustee doing the job, they will start litigation against that party, and if and when they win, the costs will come out of that their share of the house if they've managed to sort of block it to a point. So it's very important that you're in the position to perform here, or don't get yourself into more trouble here. Okay, so it may be a case, then give my example of 100,000 and it's 50-50, or and we can't afford to buy the 50, there's no point in creating a fight, because the cost potentially could eat at the non-bankrupt share. And if there's 10-15 grand of costs, that gets fairly serious. So it might be a case of, euphemistically, I'm not making light of it, wipe in the mouth and say, right, okay, we'll leave that, right, we'll sell it, and we'll walk away with your 50,000, and we'll start again. So let's not pick fights, and let's not pick the wrong fights. We've got to make sure we protect things first if we can't perform. And actions do sometimes a little bit sexist, right? Sometimes the husband will try and protect his wife, okay, and keep things from her, because sometimes that's where things go. But one of the key things here is that the co-owner of the property, the non-bankrupt, is fully aware of all the implications as well. Literally trying to protect someone doesn't do them any good, especially if it goes wrong. It actually exacerbates it, and it's particularly nasty when actions are then taken against the co-owner. As I sort of waffled on a bit there, but hopefully you get the feel for it. Don't pick your wrong fights. So home's the one, we know that. What we're going to do in this next part of this is to talk about other assets involved. And again, everything's different, everything has different implications. The mix is very different, the mix is can be very awkward. And we're just going to run through a few of them. Then it's not exhaustive, but I'm going to give you a couple of insights into a few things here. Businesses are very difficult in bankruptcy because, again, the trustee has an issue in terms of making sure he's trying to realise the best for the creditors. So if he decides to shut down a successful shop, he will possibly lose the going concern of that. That said, he needs control on that business, so he may close it for a day or two so that he can take it over and run everything there. Not necessarily that easy. So in terms of operational businesses, we've seen instances where they've come in with their size 9s and basically knackered the business by just charging and shutting it and everything else. And by the time they'd opened it, the shop had lost its goodwill, its customer base, etc. Limited companies are slightly different again, in that the actual asset the bankrupt may hold will be a piece of paper in the form of a share. Now, and it's important just to get that context exactly right. Okay, you as a bankrupt, you can't be a director, but you were a director, a shareholder, and an employee, and you have various rights in each different parties. So the trustee has to be very careful. He gets this part of how he's trying to realise any business assets very, very carefully, especially if there are, other shareholders involved. Because if it's a 50-50 shareholding, there's a bankrupt and a business partner. The business partner might say to the trustee, get stuffed, there's no value in those shares, I'm giving you nothing. So it's a trickier scenario. Whereas if you're a sole trader, everything's up for grabs. And all your business, so if you were bankrupted on basically on a set of rates, or the taxman or whoever, then you think, we've just had a case there where people think, right, I've got my credit cards, I've got that personal guarantee and everything else, but all the debts in the sole trader scenario come into play as well, which can absolutely blow the case out the water. And it's very, I'm giving you just brief examples, but each and every one of these could nearly constitute, in a sad way, different webinars, and we can give various examples of what we do there. But it's a tricky one. There's the flip side of that your income will be reliant on that business, so you can't completely eradicate somebody's income. But if this office furniture was all part of that, and we could go and get a load of IKEA chairs, that will be an approach to the trustee. The trustee would take. Cash and investments in terms of other assets at risk basically go. If you're sat on a load of shares, you're sat on some unit trust, you're sat on a bit of cash in the bank, bang, realise as quickly as it. Real easy money for the trustee, which he needs, because he or she starts off with nothing in the pot, and that's the lowest hanging fruit in every sense. In terms of investments, there are a couple of things to think of. Buy-to-lets may go under the investment umbrella, and ultimately they've got to be realised, because you don't need them to live in. There's something there with a bit of equity, and that cash can come in to help fuel the trustee's work and ultimately get the best return for the creditors. So those are a couple of points on investments. One other thing, there's specifically a question in the bankruptcy questionnaire which refers to life cover and life assurance. So if it's a term policy, in that if you stop paying, you don't have any life cover, that's got no value. But there are different types of life policies, including ones where you create an investment in there, and that is up for grabs. So you've got to be very careful there. I'm going to come forward, just miss a couple of points here and go to pensions. And in the previous webinar, we referred to them as being a very grey area. I said grey area earlier, this is a real grey area. In that, there's a couple of bits of case law, it's not quite settled down. The basic measure we work on, if you are of an age where you can access your lump sum, that needs to be looked at very carefully, because if you're in the middle of a bankruptcy and it's your 55th birthday and you can pull down 25% tax-free of your £400,000 pension fund, that 100,000 is going to land down into your affairs, and the trustee will sweep it up and take it back into the overall pot. Chattels, which are our furniture, our TVs, our living things around us, the vase, everything, they're all okay as long as they're reasonable. I gave the example the other week. If you've got an artifact, a painting that's worth squillions, that's going to be sold. If you want to replace that with an IKEA print, you work your way through it. Motor vehicles, very often a practical nuisance for people, and sometimes, and understandably to a degree, an ego issue. Could be because if I gave the example earlier of a Range Rover, say with £35,000 worth of equity in it, that's going, and you're going to get, not judging anybody, you have 1,500 quid run around mini, and that's what you need to get through. Very tough for some people to take that. I don't give a monkeys, but it's understandable, but it's a real practicality, and that car goes like that. The other one is you find even if there's no equity in the car, a lot of finance companies, especially the Germans, BMW, Volkswagen and Mercedes, if you have finance with their direct finance, invariably they come and take the car back anyway, because there's terms and conditions. In the event of personal insolvency, end of contract, we take the car back. Their losses, as may arise, then go into the bankruptcy. We've seen a couple of instances, unfortunately, of inheritances going into bankruptcy estates. And what the key date there on is, if I always use the example of Aunt Peggy. Aunt Peggy dies, is going to leave you £100,000. So that's lovely. Unfortunately, she dies or passes during your year when you're bankrupt. That money will land into the bankruptcy estate, and it's the day she died. Okay, it's the day she died. So it's unfortunate, and it would have definitely not what Aunt Peggy would have wanted, but the circumstances are such in your year of bankruptcy. Any windfalls you come into, you get the sort of veiled threat. But you've got to report things, anything material you come in. So if you get a legal award, you've been fighting for years, but it's going on forever, but suddenly there's a big offer, and it lands in that year, or the decision's in that year, then that will trigger the payout, and that in turn will go into the bankruptcy. A better measure, and I say it slightly tongue-in-cheek, is lottery winnings, day 1 to 365, don't do it. Day 366, do it, and if you win, it's yours. So it's that's a sort of example I give, trying to sort of show in the strict timelines here. And as with all assets, the trustee has 3 years to look to resolve the situation with all the assets there that he or she thinks they should realise for the benefit of the creditors and or help pay for their fees. Bit of a whistle stop to it, and again, each and every instance is very different. If you look at cash and investments, if it's a joint account between a husband and wife, the ramifications of that. It's the car situation, taking a view on whether a van really is a tool for trade rather than a vehicle. Lots of little nuances in there. And I'll give you another nuance in a minute about cars in terms of what the situation is when you are bankrupt and what goes on, practical terms. But I'm going to take another quick break here. I've got a colleague of mine, Mike, here, who's and it's a bit advertorial, but I'm just going to give you a little bit more of an insight into the sort of work that we cover. This is all about bankruptcy, trustees in bankruptcy, and debt issues. We cover a plethora of areas in terms of our work, and I just want to, yes, we're sharing this content, but I'm also going to give you a little bit of an advertorial. So work with me, and I'll see you on the other side. Thanks for your time.
Hi, I'm Michael, and I'm one of the financial services consultants here at Bell & Company. I wanted to talk to you today about who we are and what we do. We at Bell & Company are debt strategists, and we offer professional, independent insolvency advice. We cover all corporate and individual debt, specialising in issues such as bankruptcy and trustee negotiations, personal guarantees, directors' loan accounts, coronavirus business debt, and even all creditor negotiations. We can help with any debt-related issue, so if you or anyone you know are struggling, please don't hesitate to pick up the phone today to speak with one of our consultants.
So that was Mikey. Mike's a good footballer, by the way, just so everybody knows, human being as well, obviously. So we're going to cut to part 3 here, right? And again, there's a little bit of repetition, but what I want to do is bring through the stuff that we've covered, a little bit about the assets. I know it's about assets, but again, and I'm not going to apologise, because people will ask a general question such as, if I go bankrupt, will I lose my house? We need to sit down, talk about what you've got and not got then. Well, no, but will I or won't I? And it still goes back to, you've got to remember the commerciality. You can't make any decision. The more informed you are, not hundreds and hundreds of opinions, but the more informed you are on the process and the commerciality and the realistic approach to things, the better chance you've got of some sort of success in what is invariably a difficult position. So remember commerciality in bankruptcy. I don't care if people are going, jeepers, that man won't shut up about commerciality. That is what this is about. It must not, it's very hard, very easy for me to say because we're fairly black and white, but don't make it irrational. Okay, okay? Emotional. Do not worry about what other people think. Do not worry about family opinions. The old aunt going, oh, he's always a chance for him, wouldn't he? That doesn't help anything, right? Just keep the emotion out of it. You have to get the skin of a rhino with this carry-on. You'll get looked at strange and everything else. That in turn will affect your emotions and, excuse my French, knacker the commerciality and the approach you're taking because you're worried about the wrong things. We had a man whose main concern was the Range Rover going, keep calling it the Range Rover, it was in that instance, and what are people going to say at the golf club? He was on the committee. And it was mad and maddening. Emotions and show of emotions will cost you. If you sit down with a trustee, say as a couple, and you possibly understandably break down in sheds of tears because of your fear of losing your home, you show emotion, and to a fair degree you show them weakness. That's the pinch point. Let's keep nipping at that home. Let's keep nipping, nip. And it's trying to make sure that you see things for what they are. You do it on a numbers basis. You do it on commerciality. You do it on the availability of cash from others to support you. When you're looking at commerciality, it's very important to make sure the trustee understands that you're for real. If you say, yeah, we'll buy the £50,000 of equity in the house, right, but you don't perform, at some point they go, forget it, we're just going to move on. And no matter what you say, you'll not get them back. If you've got the opportunity, a relative, a friend, whoever, to come in and say, right, we'll help you, show them the money, right? Because at the end of the day, they've got to get money in to fuel the case, to pay their fees, to pay their bills, etc. So it's a self-perpetuating. So it's a wee teaser. Show them the money. And you need to focus on your MBF, understanding what he's doing, understand the person if you can. Sometimes they're cold, and they have to be like that because they come against horrendous situations, right? But see if you can work out how they're operating, what they're about. Civility costs nothing, right? If they're a complete arse, still you've got to go through that process, right? Try not to fall out of them. Some of them try and pinch you to get you to react, so you just got to be careful there. And just keep working at them, keep talking. Don't over communicate because that's the costs, right? But just keep it on a good, friendly, professional basis. Be transparent and you'll get there. If you are looking to buy an interest in anything, be it the home or things off the wish list, and you've got outside help in whatever form, then what you're going to have to make sure you do face, and they're under strict legislation on this, you've got to make sure the people that are coming up the money can prove where it came from, and it all comes under anti-money laundering legislation, and it's absolutely prevalent now in the legal world in every sense. Everyone's fearful of where money comes from in today's world, and turning up with 10 grand cash isn't going to help a situation at all. In fact, it's going to make it a lot worse because it shows that possibly you're hanging out with the wrong kind of people. That would be their view. So anti-money laundering and proof of funds in the right way is absolutely imperative. We have a number of cases where we're negotiating with banks and the like, and very often the proof of funds process is the worst part of the whole job. And especially if you've got third-party people trying to help you, and say in this instance a trustee, we want all their ID, we want to know a couple of bills, we want this, we want that, whatever, we want their bank statements, we want to know where that money came in there and things like that. And sometimes people trying to support you go, tell you what, get stuffed. No, I'm going to give them 50 grand. If you don't want it, don't take it. And they go, we can't and we won't. So just be aware there's a bit of process there. It takes a little bit of leaping through. As long as the people that are going to support you through this and help you buy interest are aware of it at the beginning, and they say, because what you don't want to do is do the hard work of trying to convince them to help you and then lose them because they didn't think they were going to get asked all these questions. You may as well let them know right at the beginning, thanks for your help, but this is what we've got to do as well. And so they're fully aware of the process they've got to go through, which may seem strange. They're going, well, I just want to give you the bloody money. But the trustees go, oh, no, we want to know what's that, what's this, what's that. And they can get a little bit too inquisitive, is the polite phrase. So anti-money laundering has to be addressed. In terms of commerciality and where you position things, I mentioned on a previous thing there, I talked of a wish list. And I'm going to give you a quick example here. A trustee was torturing a client of ours, and this man was pretty successful in terms of what he did. Went down for about £5 million, and the trustee would all go through that. I think there were about 8 assets, but it would always put the house last, the home last. And he knew, because there was an instance where he and or his good lady wife got a bit emotional about the home. So the trustee was making sure our client worked through this list vociferously, right, and did everything right and behaved, which he didn't need to be. It would just, it was an understandable tactic. It was mean. Let's sort these other 7 out, and then we'll sort your house out. And we're mates, okay? Dead on. So, and then it was starting to torture this guy. So I said, right, let me go in with you in to see the trustee, and we mixed the list up. And there were two assets in the 8 were pretty important to us, and we had the support to make sure we could sort them out with them. One was home, and the other one was his mother's home. Okay, so that's fair enough. They both had mortgages on, and we had to buy the equity. But it was torturing our client, so we said, right, okay, let's go through this list. Okay, there's a garage, there's an industrial unit, there's a house, that's that address there. Trustee, that's your home. Yeah. I spoke to 4 walls and a roof. We're not going through all this facade just to be messed about by you. That's for sale. It's going on the market. Well, it's your home. We don't care. It's going. We had to break the cycle of the trustee doing what he was doing, because they'd lost the commerciality, showing the emotion, understandable emotion. I keep saying that. So that's on the market, the way that goes, and that one there's going as well. That's where your mother lives. Yep, she's 80, whatever it is. Her days, we're going to get a nice house and we're going to rent it. We're going to get it big enough so that she can come and live with us, etc., etc. Okay, you sure on those 2? Yep, cool, get it done. Got them away at great prices, performed on the deal with outside help, and managed to get both those properties back into the Hamley repossession, safe and secure, out of the bankruptcy. Paid the dues, everything was done in the right way, all the paperwork, the valuations, sales agent reports, all done correctly, but we got it controlled, we got them gripped, and we got them back. And it's an example that shows commerciality, and also the fact that you need to understand your new best friend. If they're torturing you, let's turn it around a little bit. Let's take away the fear. And it's very important to get that point quite early, because you could go one of 2 ways when you're bankrupt. You say, right, trustee's a bastard, I'll do everything he wants. You're finding some middle ground here to make sure you keep him controlled and you keep what's near and dear to you controlled as best you possibly can. Bit waffly, but hopefully the concept sort of comes across. And the last point, we were talking to somebody the other day, and he went bankrupt. We helped him through where he was, right? And he said one of the turning points for him, and I'm not blowing smoke here, he was when I explained to him the reverse psychology of bankruptcy. So he went, I'm not going to say the actual figures, I'll give you an example of the sort of amounts involved, right? He went bankrupt for about £1 million, okay? He had a house, and he was under pressure, and I advised him to go bankrupt. Didn't want to do it. He had £250,000 of equity in his house, a grand house, but he had the support of his father-in-law, a bit disgruntled, but anyway, got over that. Let's keep it to the money. And he was going to give him the support on that. So I said, look at the reverse psychology of the deal here, right? You go bankrupt, you eradicate 750 grand of the deal. You can't get more than your worth or what can be realised. You eradicate 750. Then, I'm not sure I should call it the fun. The fun starts on how we can get that 250 lower, okay? And we did. We got it down to about 170,000 because there were a couple of issues on the title. They weren't enough to make it only appealing to a cash buyer, but it was enough to affect the value. Then it was the availability of the cash. The cash was there for a short time. That was the condition of the father-in-law. He started at 150 and said it's there till the end of August. So from today's date, literally a month away, do you want it, yes or no? So it's almost like a pile of cash sat there on the desk, do you want it, yes or no? To and fro over the month. Eventually we settled on the 170. So if you look at it, the reverse psychology, bad, nobody wants to go bankrupt. Previous webinars we've done, no one goes bankrupt for the crack. 750 of debt off the left, which you wouldn't have been able to service no matter how hard he tried. And then on the 250 he thought he was going to pay, we managed to get that with his help and his father-in-law's availability of cash, save another 80 grand down there. Everything's brilliant now. He's a number of years on down the road. Everything's good. Title issues sorted, and we're in a good place, very good place. And I would say this, but we brought that sort of structure to that deal, and it worked. At first, the client didn't get it, and that's why I tried to explain it as a reverse psychology of bankruptcy. Mumbo jumbo, maybe you think, but that's how we get it across. Okay, so again, a bit more reinforcement, because it is so vital to be transparent and keep the confidence of who you're against here, namely the trustee. So the new MBF, if you're a man or a woman of a certain age, then MBF is new best friend. That's lol talk on text. Perjury Act, going on and on about it. Don't lie, you'll get into trouble. And the ability for a trustee to investigate you gets better and better with technology, and again with the availability of litigation funding. You must understand the trustee. If they are a miserable sod, don't send them a Christmas card. If they're nice people, send them a Christmas card. But understand what they're about and what you're against. They may talk to you on the basis that you're their mate, and they put your arm around you. Don't worry, we'll get through this, right? They will give you and cannot give you any favours. They cannot say, everything's got to be justified, thus the presentation is all, in terms of offers. You don't go, right, we reckon it's 100 grand of equity, we'll give you 30. They go, okay, no problem, don't worry about it, we're putting the house on the market, we'll apply to the court. So there will be no favours. If you're giving, so in that instance of the guy with the 250 grand of equity, and we got away at 170, that wasn't a 3-page email. There were reports, there were justifications, there were availability of the cash. It's only there for so long, we don't know where else we're going to go, and da-di-da-di-da. It has to be built up. So the trustee has to be able to basically believe it, because if he is then scrutinised, he needs to say, well, I took this decision because. So it's not 30, you're not guessing wildly. You've got to come up with something constructive and validated. And last thing, if you can, and they're civil enough, like treat them like human beings, because all day it's like our dear friends at the revenue. Invariably, they just get shouted at and have a crap time. Treat them like human beings. There's nothing measurable, but you'll get the benefits back. If you hide, and I'm going to say it again, and lie, you do it at your peril. If it goes horribly wrong, it's totally indefensible. And the Perjury Act carries serious penalties and sentences, including it is criminal, so it can include custodial. It's not a judge goes, you're very naughty there. If they take it on the thing that you're basically there's a criminal act here, there's a good chance there's some sort of incarceration. Assets will be found. All right? If there's a bit of money in the pot, it gives the trustee the ability to go looking around and going through all your bank statements and say, see this payment here, why did you pay a load of money in Portugal when you're away? And go and look at the resort, find out there's your name on a property and things like that. And there's some serious private detectives out there scouring through things. I've seen a couple of absolutely brutal reports about people, and bit nasty, a little bit judgmental, but that was a weakness on their part. That let sales push back. But our client was telling porkies, and so it transpired when it came out. Not as bad as the private detective decided, but still it not totally undermines. It's really hard work then to say, because from our angle we're trying to give you third-party representation. We're not going to be sullied by your lies, but the trustee will look at us sideways, and so far it makes the process a lot harder. But we just keep going and we get through it. They will be found. And people do talk. People will lift the phone to the official receiver and say they've got a nice caravan, I hear. Throwaway comment. This example I'm giving you here is this guy was not quite as cute as he thought he was. He was sharp enough. The Audi A7 his wife bought. She was a director of the company. She had access to money, her own money and everything else. So he was driving around town in his Audi A7, brilliant white, very subtle car, but with a number plate which gave away his allegiance to a certain football club, and part of the lettering was KOP. So somebody had rung up. It was a bit Marmite, this character. A local person had rung up and said, this man's still driving around in a £40,000 car, whatever it is, and the number plate is this KOP. So the trustee, the official receiver, questioned the client on this and said, right, what's this car you've got here? Rather smugly, that's my wife's car, always has been, always will be, da-bi-da-bi-da. Cool. Who owns the number plate? I do, good, because I've just had it valued, it's worth 2,500. Give me the 2,500 or the number plate goes on the market. And it was a bit of a kick for the man, big hit on the ego, couldn't let that go, so consequently, by being smug, even though he thought he covered his tracks, he got caught for 2,500. But people do go forward, do grass people up. It's in their armory. I'm not judging that either way. The client shouldn't have put himself in that position. In that position, he was materially right. Our client, he conducted himself correctly, but had access to the car. And that's why in the bankruptcy forms it asks, do you own a vehicle? Da-da-da-da-da, details. Do you have access to other vehicles? So when you do get the grass ringing up, they say, yeah, I have access to that car, which he did with this instance, and that was covered. But where he got a bit arrogant with it, the trustee decided to take £2,500 off him for his KOP number plate. If we fail to do it, if we fail to conduct ourselves properly, fall out the trustee on a regular basis, fall victim to the Perjury Act because we lied, everything, and I will keep saying it again, becomes a lot harder to do, because nobody is trusted. Nobody trusts anybody, and that's not good for discussion. That's not, you look, everyone's looking at one another a bit sideways, and it's unnecessarily hard. And people sometimes think they're clever doing it, and they really aren't. So we're just going to finish off here in this last section with a bit of generic advice. Okay, a lot of this is generic, I get that, right? But saying it again, every case is different, without a shadow of doubt. It doesn't matter who there's no plan 23 applies here. So a couple of bits of generic advice, okay? Be realistic from the outset. If it's bad news, face the bad news early on. Otherwise, you're putting it down the track. It gets more and more painful. If you're trying to hide things from your family, the trustee, and everything else, it's going to get worse. Okay, get the best specific advice. Okay, your generic high street lawyer, a bit like that other guy with the lady that didn't sleep for a year because he told her she was just going to lose her house, even though it was in negative equity and she was paying the loans off. Understand the full ramifications of your asset risk, okay? Because you need to be able to put that across to whoever the specialist you're talking to. So you need to understand it so that you can impart that across to them. Realistic valuations are vital. Any number of times, particularly in the south of England, say, where values are going like that, people go, it's about 600,000 it's worth. Just on Rightmove, there's something next door for 825. It's ridiculously unrealistic, and he's digging himself into a bigger hole by being, I don't think stupid, but being a bit devious, and it's not useful. Being realistic, you got to know what you're in for. No point in kidding yourself. You're not going to kid the trustee, so there's no point in kidding yourself. Now, a couple of bits in terms of advisors. High street solicitor, as long as they're involved on a regular basis in insolvency, by all means approach them. Do not go to a solicitor merely because he was very good at conveyance in that last property purchase. Okay, you don't want them getting out and dusting the book down. Let's have a look in here. You need practical, specific advice. People that experience this regularly. We, for our part, and it's what we do day in, day out. We no one should ever purport to know everything, but we have a lot of experience, a lot of practical experience on what we've gone through. You could approach an insolvency practitioner, but I'd always add a little bit of a caveat to that. And further down the track, that can cause conflicts, and you have to be very careful, because don't forget you're opening up. You've got to tell them the ramifications of your situation. If you start hiding things back, they're not going to be able to give you possibly the best specific advice. And IPs are just on the edge there in terms of what they can advise and what they can't do. If you know somebody, or somebody can introduce you to somebody where you can have a full and frank conversation, cool, but other than that, be careful. You need to know what the reasonable outcome is going to be, the realistic outcome is going to be. The man that's going, it's worth 600,000, but it was worth 825,000 plus, that's not realistic. He's going to shoot himself in the foot there. He's had to redo his outcome and look at the logistics of how he's going to make sure he gets that extra money he's going to need here. And don't kid yourself, but most importantly, please don't kid your family. The phrase, it will be all right, it'll be all right, okay, it's not going to be all right. You've got to address the problem, deal with it, involve you. It's painful. It can cause long-term damage to your relationship, but it'll be a lot worse if you lie and hide things. And so it's very important in terms of that realistic thing that the key parties to the decision making are involved. Be that your wife, your partner, your husband, whoever it is, plus whoever's helping you fund the situation. Everybody needs to be fully aware of what's going on, and then you can work as a team to get through it. So the best specific advice, okay, so the best would be a commercial insolvency solicitor that you can go in, who can give you, like I say, works day in, day out in terms of what he does. They will take a view. They can give you advice, okay? They can give you the advice, give you the ins and outs of what's going to happen and the ramifications of it, but be very careful with costs there, especially if you get them involved in trying to avoid a bankruptcy, for instance. And again, you have that situation where there could potentially be conflict if they have to open up and tell them everything. Not in a dodgy way, but it's, they've a certain way to carry on. We at Bell & Company sort of pride ourselves by taking a whole view of a situation, not just, there's an asset, what do we do with it? We've got to look at the whole situation that's going on here. And we go, again, going about know the worst, achieve the best, right? You've got to make sure you take that whole approach, you bring everything in. If we looked at that case with the man with the 8 properties there and just gave advice on his home and his mother's house, that wouldn't have worked. So that's why we need the whole thing, so we can say, right, this is what you should do. I'm slightly promoting us, but we know our stuff here. We have a very good team here. We have brilliant advisors as well. We don't know everything. We've got direct access barristers, we've got solicitors on friends and family, we've got barristers here that we can go direct to, and within reason anywhere in Europe as well. So we're pretty well versed in what we do, and or we know where to go if we're not sure on it. Whatever you do, don't Google things, okay? Because you will find, if you're looking for something, you will find a case study that suits just your idea and thoughts on how this will pan out. And you will then hang on that, because I looked at Google. So a number of people that come and tell us our job because they've Googled it. And they are talking absolute garbage invariably. There's a case here, look, and whatever. Yeah, but what about the mother's house and the 7 cars you own, right? It's very important that we make sure we get that point across. Third party, inhuman advice will not solve your problem. Never will. Never will. Same with the health thing. You go and look on Google for health, you can come off and be terminally ill if you choose to look for it. So going on a little bit there, a little bit of a rant on a couple of bits there, but it's a tough one. It's a bit conceptual. It's very important, the whole makeup of the deal, and hopefully the 3 webinars are giving you a bit of an insight in terms of what happens in bankruptcy. Hopefully it takes away a few of the fears. Okay, undoubtedly there's fears, like we keep saying, and also a few of the practicalities. And you're dealing with people, you're dealing with money, you've got to be able to conduct yourself properly. So that's the end of that short series of webinars. That's us. If you've got a specific question coming out of this webinar that you'd like to discuss, ping me an email on that email address. There'll be no charge. If somebody wants us to look at their case and take them on, of course we've got to talk candy. But from this webinar, advices that are requested, or I'm sure there'll be one of my learning friends will come back and say, Terry, that was garbage, that bit you said there, and I got a technicality I missed. I will report that back to the audience and say, right, bit of a cock up and slide, whatever it was, and we'll get that right. But that's us. You're welcome to what we've done here. I'm not going to apologise for the adverts, but because we've got to make a living as well. But we're putting this out there just so that hopefully it helps some people. If somebody sleeps a bit better, that'll be great. Anyway, thanks for your time. Good luck. Stay safe. Bye-bye. Cheers.